So if you've been paying attention to startup land, you may have noticed that valuations have come tumbling down over the last year since the end of 2021. And that is going to have major repercussions across the entire venture capital landscape and ecosystem. My guess, and this is shared by a bunch of others, is that upwards of 50 to 60% of venture funds will essentially disappear, or better put, they'll probably become what we call zombie funds in the industry. A zombie fund is just really a fund that's existing but doesn't make new investments. And so it's kind of alive, but not really. As a founder, you need to know if the fund you're talking to is a zombie fund or not. And so we're going to talk about that. But first, let's understand how we got here to begin with. So to understand how we got here, you got to understand a little bit of basic economics. Since the last recession, I'm talking way back in 2007 through 2009, the Fed since then has been pumping crazy amounts of money into the economy on a consistent basis. This has basically driven interest rates to effectively zero. If you think about how inflation over the long run is about 3%, well, interest rates dropped down to like sub 2% in some cases for mortgages. So it was like a no-brainer to buy a house because you could buy the house on 2% and then you just pay it back with inflated dollars over time, which is kind of exactly what's happening right now as we deal with high inflation. But what that did is this capital was looking for places to generate return. And so a lot of investors were putting money into venture capital because they were seeing the wins from companies like Airbnb and Uber and Lyft and Pinterest and Postmates and so on and so forth. And as investors saw more and more companies start to perform and generate profits for their funds, that enticed more investors to invest in venture capital funds. The other thing is that in the public markets, there was a lot of money going into mutual funds and hedge funds and so forth, and they were all competing for the very best deals, which pushed up valuations, which ended up driving great returns for venture investors. If you think about how a venture capital fund gets started, it's usually one of two ways. You either have somebody that worked at a venture fund, built up a track record, leaves that venture fund and starts their own venture fund using the track record they've built, or that's an angel investor that has gone out and made a handful of investments, usually because they either have made a lot of money along their career as an operator and or they started their own company and it was successful and generated a lot of cash that they could then invest in other companies. On the angel side, historically, it can be really hard to generate a good return. But over the last decade or so, there have been lots of angels that have generated really good returns because they've gotten into some of these early stage businesses in 10 years ago when capital wasn't as cheap and freely available as it was back in 2020, 2021. And as capital became more and more available, that helped push up valuations across the board. And by the time they exited their investment 10 years later, these companies were extremely highly valued and they were able to generate really, really great returns. They were then in turn able to take those returns and that track record that they built and go pitch investors and say, hey, look, I was an early investor in Robinhood. I was an early investor in Lyft. I was an early investor in Wish. And look how big these companies are and how successful and what kind of return I've generated. And so you should invest in my fund and I will continue to invest in these great world-changing companies going forward. But now, of course, as you can probably guess, here's the rub. If your returns were really driven not by so much the performance of the company as much as just like the free cash that was available for everybody to use, then you might end up being in a situation where all of a sudden when the market turns and cash becomes really expensive, capital becomes expensive, how do you continue to perform and be a good investor? You actually saw this exact same thing play out back in the last dot-com boom and bust. So during the 90s, you had this swell where anybody that touched anything that had to do with the internet could generate huge returns, right? You had companies like Netscape that had never generated $1 in revenue go public at $1 billion valuation, right? And the investors that put money into that, like they were in that investment for like less than 2 years and generated huge home run returns. And it was story after story after story like that. And so there were tons of venture funds that were able to demonstrate really good performance, and partners were leaving those funds and starting their own funds, and there were angel investors that were making a ton of money and they were starting their own funds. And so you went from an industry that at the beginning of the 90s was super small, nobody really knew about it, there were only a handful of firms on Sand Hill Road, all the way up from like, a handful to 1,000 firms over the course of a decade. And then over the course of the next decade was actually like kind of a rough time for venture capital. That's actually when I started. I started working in 2007, so kind of near the tail end. And I remember that even then there were a lot of funds that had raised during the late 90s and early 2000s, and then the market imploded and they watched all of their investments almost go to zero and just struggle, and they no longer had the performance necessary to convince investors to give them more money to make investments. And so the whole venture industry was just kind of like meh, especially compared to where it is today. After the last recession, though, the Fed started pumping more money into the economy, and that started to really pick up things. The other thing is you had a lot of people in the last recession that got laid off, and that was the push that they needed to go out and start really interesting businesses. So there were a lot of great companies that were started during the last recession, companies like Airbnb and Uber and others. Those companies and the access to capital led to huge growth and huge valuation increases over the last, 10 to 12 years. And that, of course, in turn resulted in a whole bunch of new funds getting raised in, you guessed it, 2001. 2001 and even 2022 were record years for fundraising for venture capitalists because they had these incredible track records that they could sell to investors. The big challenge, though, is whether or not these funds are going to be able to raise their next fund based on these changing dynamics where you can't just rely on the Fed to pump up your valuations over time. One of the big challenges, though, is that we went from 1,000 funds down to 400-ish funds between 2001 through 2010, roughly, because funds last for about 10 years, but they only invest for about 3 years. And then we steadily increased all the way back up to over 1,000 funds today. The challenge is that as we've done that, funds that were raised in 2017, 2018, 2019, if you've only got a 3-year investment period, you've gone through that entire investment period. And then you get 2021, which was great. If you were smart, you raised your next fund in 2021. But if the timing didn't work out for you and you're really thinking that maybe 2022 or 2023 was the year that you were going to raise your next fund, you're in a tough spot because right now you're getting hit with valuations decreases. These venture investors are getting hit with drops in valuation. Their companies are probably struggling to raise additional capital. And LPs, investors in these funds, or would-be investors in these funds, are seeing two dynamics play out against them at once. One, they're watching their other investments, their other portfolio drop by quite a bit in the public markets and in the private equity markets and so forth, which just leaves them with less cash to play with. You've got inflation that's hitting them, so their purchasing power of their cash is going down. And then on top of that, the performance of these funds is also going down. As they get repriced, they go through down rounds, they go out of business, all of those different things. And so that's going to result in a tightening, I think, especially in 2023, of the venture market. And those that still continue to invest in the venture market are probably not going to invest in the brand new venture funds. They're going to back the tried and true, successful ones. And that's exactly what you saw in 2022. In 2021, there were a lot of small funds that raised money and a lot of big funds that raised money. In 2022, it was pretty much only big funds that raised money. And that was really a bet on like, hey, we need to keep supporting these funds. We invest over the long run. We don't just invest fund by fund. We're going to back managers over the long run, but we're going to back managers that we know and trust, and those that we believe have the staying power to be here in the next 10, 20, 30 years. And so that's why a lot of the money has flown to the big guys. Now, I said at the beginning, you need to be wary of zombie funds. So how do you know if a company is a zombie fund? Well, the easiest way is just to ask them, what's the last deal they did? And then go talk to the entrepreneur. Find out, did they really invest a meaningful amount into the company? And how have they communicated to that entrepreneur the reserves that they have for follow-on investments? What you don't want to do is either waste a ton of your time talking to a zombie fund that's ultimately not going to invest, or take a very small check from them when you know that they don't have the capital to pony up for additional rounds of capital, especially if things go sideways and you need their additional support later on. That can be really hard to deal with. But here's the rub, is that, venture operators are probably going to try and hide the fact that they are a zombie fund, that they haven't been able to raise another fund. A zombie fund is simply like, as a fund, my fund lasts 10 years. I get paid management fees for 10 years to keep the lights on, support the portfolio companies, et cetera, et cetera. But I'm going to place all my bets for the most part. I'm going to do most of my investing in the first 3 to 5 years, typically 3 years, and in some cases as short as 1 year. So imagine you're a venture fund. You raised let's say you raised your fund in 2019. You start deploying in 2019. 2019 is a great year. COVID hits. Everybody gets scared. You push pause for 6 months. Then you come back and start investing again. 2021 is a crazy year. You're just investing like crazy, but you're doing it at super high valuations. And now it's 2023. You're outside of your investment period. So you're not making investments in new companies, but you're watching the valuations of the companies that you did invest in 2021 start to come down. And even if they haven't come down on paper, your investors kind of know that there's a high degree of likelihood that they're going to start coming down. And so it becomes really hard for you to go out and convince investors to invest in your next fund. And so what do? Well, you don't want to just shut your doors. You want to come off as like you're still a legit VC deploying capital, but you don't actually have capital to deploy, at least in new businesses. But you still have another 7 years to operate as a fund. And so because of ego and because of the way the venture model is structured, there are probably going to be a lot of these 1,000 venture funds that have joined the ecosystem over the last little bit, still floating around here until probably, 2028 as zombie funds. And so one of the first things you should always do from this point going forward, in my opinion, is when you're meeting with a venture fund, you should do your own due diligence and make sure they're actually investing so you don't waste your time. Anyways, if this video was helpful to you, check out some of my others, like where I dissect the performance of Daymond, the shark on Shark Tank.